We're going to look at SolarEdge Technologies. This, again, was a dog of the week in late 2024. It cratered from its highs. The stock has kind of dead cat bounced to start this year. Maybe it is more sustainable, but Brett's going to try to let you know right now.
Yeah, so like Ryan said, last time we looked at SolarEdge, it was in late 2024 as a dog of a week. I think we've looked at it a couple of times, though, and as well looked at it in some of our reports for our clients within, I think, a couple of special reports. But the stock really collapsed due to poor financial performance. Its gross margins went negative. There was massive inventory glut in Europe and within the company itself. And it was driven by really Chinese competition as well as just a globally weak solar market as a whole. And then that resulted in a big write down in inventory last year. So really, what's happened since then? Has it actually improved? Are we going to see some degree of a turnaround? What is going on? So a quick description of the company, if you don't know what it is. SolarEdge specializes in creating direct and current optimized inverter systems for solar photovoltaic applications. Their offerings include power optimizers, inverters, and a cloud-driven monitoring platform catering to various solar market segments, so household, commercial. This includes everything from that small-scale residential solar project to commercial and smaller utility-scale solar deployments. The stock has had a strong performance in 2025, up 41% year-to-date to $20.89 a share at the time of recording. However, this is still just a tiny fraction from its highs in 2023 or before the 2023 drop. It was trading at high $200, low $300 range. So you're down still 90+% since that height in valuation during that time. So is the 2025 recovery built on sustainable growth? Are we actually going to see a proper turnaround, or is it just a dead cat bounce? What is going on? So looking at this Q1 2025 numbers, revenue saw slight growth year over year of 7% to $219 million. Good to see it's not declining, but it's not the biggest growth what you would really hope for in a turnaround story at the time. However, more importantly, the gross margins are once again positive. Positive gross margins, that is something to celebrate, and they are at 8% on a GAAP basis. Obviously, still not great margins for a long-term business. That's not sustainable for a long-term business, especially we're just talking gross margins, not even net income margins, but it's at least a shift in the right direction from those significant made negative margins. Mind you, in Q3 last year, if you are looking at it, that was because they had a significant write down. It was still poor, don't get me wrong, but it wasn't as poor as it appears to be on the surface. It was an accounting number shift. So prior to that major decline in 23 and the write down, a more normalized margin for the business was in the low 30s%, just for a point of comparison. So if you are looking for them to work back up to what they were prior to the collapse, look into that 30% range if you are expecting that. And as gross margins are just so slim, it's no surprise that the company continues its net loss streak at a loss of $98.5 million or $1.70 share loss. The balance sheet still remains relatively strong as it had a massive net cash position prior to really the market decline, but it has since fallen to $113 million in net cash, which is positive. That's still good, especially considering the market cap itself has declined significantly, and the company expects to be able to now pay its 2025 convertible debt as it comes due later this year. That was a concern by many investors and skeptics of the company is, are they even going to be able to remain solvent? Which at this time, that doesn't seem to be concerned. They are expecting now to be able to have free cash flow break even, which I'll get into in a minute. But overall, it seems to be fine, at least for cash flow for 2025. But the company still does have a massive inventory balance of $637 million, about half its market cap, slightly lower sequentially, which is a positive to see a decline in those inventory levels, as is that is something they need to work through over time, and they have been working through. So good to see, but it still remains just way too high at this time. So moving to the guidance, for Q2 management guidance, revenue between $265 to $285 million, non-GAAP gross margin between 8 and 12%, which includes a 2% negative impact from tariffs. As well, I will note this was before the lowering of the Chinese tariffs from that 145%. So likely they're going to have a bit less of an impact during the quarter, but we'll see how that shakes out. And that was also net of some price increases. And the company expects non-GAAP operating expense of $90 to $95 million. Putting this all together, non-GAAP operating losses will still be in that $60 million range. So still significantly unprofitable. As well, for the full year, the company now expects to be free cash flow break even. This is actually lower expectations from prior expectations of being free cash flow positive, the shift being due to those tariffs. So we'll see how that shakes out now that we've seen a further change since their quarter's end. But a large part of this working capital or free cash flow break even is due to working capital management relating through that work through of surplus inventory as well as accounts receivable and so on. So we'll see if they are able to bring that more in line with really levels that can actually support the business and not be a hindrance on the business. And as well as it was really a focus of the company prior, and really what we need to look through going forward, as it really has been headwinds for the company, is this European operations. The management believes inventory in Europe should start to really normalize by the end of Q2. The company has been providing discounts in the market to regain some market share, as they lost significant market share during that decline. And once the inventory levels are normalized, they believe they will be able to reduce some levels, the level of support, so discounts to their distributors, which will be a good thing for their gross profit margins. But overall, the European market is still expected to decline year over year. But they have seen that shift in the terms of their own market share. So they are being positive when it comes to themselves, but not really a bit of a less negative, I guess, sentiment towards the European market as a whole, but still generally negative. Prior to the collapse in 2023, Europe really was the company's biggest market, but in this last quarter, it was only 24% of revenue, just to give you a size of the shift. So, but a shift in the European market going forward could be a major catalyst for recovery for SolarEdge. But just as a note, Europe did have an energy crisis during the 2023 time period. So there was a massive, really above average demand during that period. So without the massive supply influx, demand will likely not be the same as it was during that period. But a middle ground should be more obtainable, because right now we're just seeing really the negative side. 2023, 2022, we saw that massive over demand environment due to the energy crisis in the continent. Valuation wise, you don't really have much to go on, as the company isn't profitable, not the greatest metric, but is that trading at 1.3 times price to sales, which is cheap, but that's for obvious reasons, as such low margins at this time. But it is discounted reasonably because of that weakness. But looking forward, which is the more interesting thing, because it is really trying to become a turnaround story as far as holders of the company would hope, at least. That seems to be fine at the current levels, with the repayment of the 2025 notes being manageable under the current cash and marketable securities position. The next repayment for its note isn't until 2029, so solvency risk is really off the table, and I would say it's relatively low of concern unless something major happens between the repayment, giving the company some time to recover until that 2029 repayment. If the company can remain free cash flow, break even, or positive, they'd be fine in that scenario, as well as they are overall in net cash position. Of course, there is no guarantee that the company can remain in a free cash flow or break even or positive position, but for 2025, that's what they're guiding. Long term, we do need to see a shift back to that positive free cash flow to create any real value for shareholders, though, and not just really pushing down on that working capital. We do need to see actual earnings profitability as well. Tariffs, while negative for the company, probably won't be the make or break factor for the company, as they did have some Chinese supply chain, but they are not. It's a bit less than what the market was really expecting, with that 2% on the higher tariffs, and the tariffs have been obviously pulled back a bit since then. The company does have U.S. production, which avoids a degree of tariffs, and has been wrapping up production within the country. The company has capacity for 70,000 inverters per quarter within the U.S. at this time. Further, like most companies, SolarEdge is looking to further diversify its supply chain to avoid tariffs. As well, they've actually had a bit of a tailwind over the past couple weeks, as the 45X tax credit for renewable energy infrastructure seems to be intact in the U.S. There was the question about, was that going to be cut out of the budget? And at this time, it seems it hasn't went through, I believe, the House in the U.S. at this time, but it's at least in the current budget. So that is a good tailwind, because there was quite a bit of skepticism if that was going to be removed, which would have dampened the solar industry in the U.S. and renewable industry in the U.S. as a whole. So overall, benefit for SolarEdge with that looking to be intact. So for investors, is this a turning point? Maybe prospects have improved, but this is not a confirmed turnaround by any means. Gross margin has improved, but it's still far, far away from that high enough level to be a net profitable business, especially over the long term. Further economies of scale is still just lacking. Sales are low. Q2 guidance does imply some sequential growth as well as year-over-year growth, but not at the levels needed for long-term profitability. So for now, we're nowhere near a buy or anything like that, but we will continue to monitor the company for turnaround potential. And for disclosure, we have no relationship or positions in the company.
Yeah, it's a good summary. We just, we monitor companies like this. If we don't have existing current profitability and significant cash flow, it's not a company that we can invest in. But it gives you an idea of, the countless number of companies that we are evaluating, looking at on a daily, annual, monthly basis. It's a company that we continue to monitor, but it wouldn't meet our criteria right now.
Yeah, these
Imagine,
sorts of...
or go on, Brett.
Oh, okay. I'll go ahead.
Canadian standoff.
Yeah, Canadians. But yeah, the thing about these turnaround companies is we don't like them in the early innings. We need them to be at the 6th, 7th, 8th inning before we can even consider it. It's not, this is very, very early on in what would be a turnaround. And many of these turnaround stories do fall apart more often than not by far.
Yeah.
They're 9 out of 10 fall apart, or they just stay in this zombie corporate mode for years and years. And you don't want to hold that either as an investor. You want something that actually creates value. And that's what I was really wanting to get to with that free cash flow just being break even. Over the long term, you do need to see a positive to create actual shareholder value. You might see some fluctuations like we have seen with the valuation really doubling since it's low, but it's not sustainable. Those are on the speculative upsides, which I went through here.
Yeah, and all I was going to say is just, how grim the stock price would have got if this was a company that had, maybe a net debt position of 200 million or something like that, rather than a net cash position. Again, it's just, pounding that into listeners' heads.
A good balance sheet helps, without a doubt.
A good balance sheet helps as a bottom in the stock for sure.
Yeah.
Yeah, I forget what it was during its peak, but it was, I think, 1.5 billion or something. Just like they have drawn down. It might have even been more than that. It was significant, a net cash position.